Today is a really red day on the market. In this video, I'm going to give you 3 things that you can do to balance or hedge your swing trades when the markets are red. Hedging your positions means to take some capital and put it into another position that will offset the losing position that you may have on a red day in the market. So although your portfolio may be dropping and your overall balance looks to be dropping, this position would offset that because this position would be going up. The object is to attain a balance. Method number 1, buy the ETF called UVXY. This is the VIX. Now you can see that the VIX ran today along with UVXY. The VIX measures volatility, and now typically when the SP 500 is dropping, then the VIX is high. That is when we would start looking at UVXY. Now how do we know when it's time to buy UVXY? Basically, I'm always keeping an eye on this ticker, and I'm looking for volume to be coming in the mornings. So if volume starts coming in the mornings, on top of that, we can see some support being established the day before. Also, in the morning, we see SPY with a gap down. This is when it's a clue to get into this ticker. If you decide to buy UVXY to hedge your positions, remember not to stay in it very long, as it does lose value very quickly. Method number 2 is to buy puts on SPY. Options can be very complicated. If you've never bought options before, make sure you do further research. This was this morning, and when we saw UVXY getting lots of volume in the morning, we could have checked into SPY and saw that it was getting lots of bear volume in the morning, and the expectation would be that this would continue to drop. Unfortunately, you cannot buy puts when the market is closed, so we wait till the open, and when we opened, we did start to move up. However, we did not go beyond the pre-market high. So that is a clue that we're going to reject some resistance here and then start to dip. So as soon as that happens, that is when we should be shopping for puts. Method number 3 is to buy an inverse ETF. Now this is SPXS. This runs directly opposite to SPY times 3. So this is another one that you do not want to hold for long, but when you see that SPY is going to be dropping, you can get into this and then you should get a pretty nice move with SPY dipping. Here are some other inverse ETFs that you can look at when the market is dropping. Inverse ETFs lose their value very similar in the way that UVXY will lose its value. So you don't want to stay in this one for very long either. And just a quick recap, these are the 3 things we talked about in this video that you can do to hedge your positions in a red market. If you want me to go in detail on any of these 3 methods, please leave your comments below.